If you've started looking into different mortgage loan options, then you've heard of a few different loan programs at this point. FHA, VA, conventional. But what exactly are conventional loans? How do they work? What makes them different? Are they even the best option for you? My name is Jordan. I'm a licensed mortgage loan officer, and this video is going to explain those things for you. Conventional loans are actually the most popular type of mortgage loan. Yahoo Finance actually said that in 2023, over 77% of mortgage loans were these conventional loan programs. What makes them different is that they're simply not sponsored or insured by the government. So FHA, VA, and USDA loans are all sponsored or insured by the government in some way. The government sets the guidelines for those ones, and these guidelines are set a little bit different. But one of the government loan guidelines is that they're all for primary residences, meaning that they're owner-occupied, or you're buying the house because you intend to live in it. Conventional loans are a little bit different in that they can be used for primary residence. They can also be used for second homes or investment properties. Conventional loans typically fall into two different categories. The first being a conforming loan. These conforming loans have guidelines that are set by Fannie Mae and Freddie Mac. You may have heard of Fannie and Freddie before, and I'll have a different video explaining them and how all this works. But what they do is they set guidelines for these loans to be bought and sold on the secondary mortgage market. I know that might be confusing if you're hearing that for the first time, that mortgages are bought and resold, but it's actually a pretty common part of the mortgage process. One of these guidelines is a conforming loan limit. So for 2026, the conforming loan limit was $832,750. If you wanted to have a loan that's higher than that number, then you could still get it with a conventional loan, but that's when it falls into a non-conforming loan. These non-conforming loans have guidelines that aren't set by Fannie and Freddie, but they're set by the specific lenders that's actually lending out the money. So one example of these is that loan limit. Another one might be a different credit score requirement or a different down payment requirement. Maybe there's a different type of property, a non-conventional home that Fannie and Freddie wouldn't be able to lend money on, but this lender would. Those would all be examples of non-conforming loans. These are some of the guidelines that are set by Fannie and Freddie for their conforming loans. The first being a credit score requirement of at least 620. Next, with down payment, typically it's required for at least 5%, but if you're a first-time home buyer, you might qualify for a 3% down payment program. Something to keep in mind is that if you have less than 20% down when you're buying a home, then you're going to be paying private mortgage insurance to start. Paying private mortgage insurance, there's pros and cons to it, but biggest pro is that you can get into this home sooner than it would take to save up the money for 20% down. And the good news is that once you reach 20% equity in the home, then that private mortgage insurance is going to come off. And finally, we have debt to income ratio. Debt to income ratio for conventional loans has to be under 50%. So when we look at debt to income ratio, we take a look at what your new mortgage payment would be, what other monthly debt payments you have, like a car loan, student loans, credit cards, those kind of things. And those added together would have to be less than half of what your monthly income is. An example I have here is, say that you and a spouse made $84,000 a year. That would be $7,000 a month. 50% of that would be $3,500. So for your debt to income ratio to be under 50%, then your new mortgage payment plus your other debt payments would have to be less than $3,500 a month. And if you're looking into a conventional loan, here's just some things that I want you to keep in mind while you're going through this process. The guidelines are a little bit more restrictive with Fannie and Freddie than they are with government loans like FHA. They're really meant for buyers that have a higher down payment and a higher credit score. So even if you qualify for a conventional loan, like you have a 625 credit score and a 5% down payment, the monthly payment and the interest rate is probably going to be better for you if you go with an FHA loan. When you qualify for these loans, you'll qualify for a few different options. And that's a conversation that you should have with your loan officer or whoever's helping you with this mortgage process and see which one's going to be the best option for me. This was just a quick explanation of conventional loans and what they are and how they work. And hopefully it gave you a few things to think about when you're considering if they're the right option for you. I hope you stick around, watch some of the other videos, and I'll see you in the next one.